So when Bill did call me and asked me to do this presentation, once he'd calmed down from the rejection from Joe, he sort of got around to saying, well, just talk about the markets, just the normal thing, talk about the market. And so anyone who's been to one of my presentations before knows that I'm not particularly keen just to sort of get into USDA numbers. I mean, that's our day job. We do it every day. We talk about the market. We talk about the spreads. And sometimes I even bore myself to tears. I mean, I've just come from 2 days in London talking about sugar, and now I'm about to embark on 2 days in Liverpool talking about cotton. And honestly, I mean, I love it. It's in my DNA. It engages me. But after 4 days of it, I mean, no one's more bored of my voice than me, okay? So I thought, you know what, I'm going to go a little bit off topic, a little bit tangential. And so I took Bill at his word. I want you to talk about the market. So I interpreted this very literally. So I'm going to talk about the market, if you will indulge me, a little bit more philosophically. So I asked the question to myself, well, what is the market? And I thought the best way to answer this question was to think about a sort of compare and contrast. Let's start with what is the public perception of the market? And then I'll compare that with my, scary to think this, my 30 years of experience of actually living the market day in, day out. And so to get the public perception of the market, I did a couple of things. I did straw polls of some of my friends who aren't in the business. I went on to things like the ICE and CBOT's website to see how they describe themselves. And these are some of the adjectives that they came up with. So it's objective, it's reliable, it's fair, it's transparent, sophisticated, secure, efficient, disciplined, and accurate. I see some murmuring, some nodding of heads. So I think there's like, yeah, that sounds about right. And when I try and conjure up an image of what does this market look like, we've got electronic exchanges now, I kind of close my eyes and I think, it's like a air-conditioned, efficient, quietly humming server room, doing millions of calculations and offsetting transactions every second. That's how it feels, yeah? That's the public perception of the market. This is hogwash. My experience of the market could not be more different, okay? The market, to me, is animalistic. It's visceral. I feel it emotionally. I don't feel it's disciplined at all. So I sat down with a notepad, and I started writing down, well, how do I feel about the market? How do I express the market? And these are the adjectives that I came up with. Keeps me awake at night. I'm only 40 years old, I wish that was the case. It's unforgiving. It's relentlessly unforgiving. This one I particularly hate. It knows where my sell stops and my buy stops are. It always eats them for breakfast and then reverses immediately. It does it all the time. If I don't have a sell stop in, the market will meander and do nothing. As soon as I put a sell stop in, it's like a laser-guided missile for it. Knows your weaknesses. That's why algos are so good. They don't have, they don't have emotions. They don't wake up moody. I wake up moody. I wake up good. I wake up good. I feel ridiculously bullish. Let's put a few more lots on. Market hates it, and it holds grudges. My God, does it hold grudges? You have a good month. You've got to steel yourself for some pain coming the next time. Doesn't like you to be a winner for too long. It's merciless. And, kind of captures all this stuff. The market is utterly, utterly, utterly immune to your pain. So is this a server room? Is this a quietly humming server room somewhere, somewhere in a Scandinavian country? No, it's not. This is a T-100 Terminator sent from the future to take your money from you. So that's my experience of the market. It's, like I said, it's visceral. Really is. And doing this reminded me, again, relates back to Liverpool, of one of my early mentors who, I won't name, so this quote is anonymous, But he told me, and I paraphrase this a bit, but he told me that the futures market is a uniquely efficient mechanism designed to inflict the most amount of pain upon the greatest number of people. And I mean, it is amusing, and it's quite flippant, but actually what I want to show you now is that this is a fantastic lens to analyze the market. And what's so great about it is that you don't need to think about supply and demand. You don't need to think about the structure of the market. You don't need to think about technicals. You don't need to think about government programs. If you can just dissect the market and figure out who has got most to lose, who is this Terminator going to come and gunning for, then you can figure out which way the market's going to go. You just bet against that person who's got all the exposure. So you look a bit quizzical. I can see some doubt creeping in. You're all nodding along nicely before. Now I've got to the point where I think I need to convince you a bit. So we're going to do a back test. First half of 24 was a pretty roller coaster year, yeah? You know, we started at 80, went up to 105. By 4 months in, we're back down at 80, and then carried on through June, taking another 10% or so out of the market to go down to the high 60s. And so we can use this new lens we have to view the market to analyze what happened then. So we don't need to think about what US export sales were doing. We don't need to think about whether there was a drought in Texas or not. We just need to analyze it through who was long, who was short, and who had overextended themselves. We can do that easily. We've got, thankfully in cotton, the COT report, and we have the cotton on call report. So we can break down, and I've kind of simplified it a little bit for this, but just into 4 very straightforward categories. So we've got producer, merchant, user, which is, for me and a lot of us in here, the trade. We've got managed money, which is the funds, and we take that from the Commitment to Traders report. Then we've got the on-call report, also issued by the CFTC, which tells us what the latent, or the open number of on-call sales and the open number of on-call purchases. So what that tells us for the sales is the latent amount of buying that mills have committed to do but haven't yet bought, and the reverse, obviously, for on-call purchases, the latent amount of selling, hedge pressure, that the producers need to do, but they have not yet made that commitment to sell futures. And so if we look at where the numbers were in the first week of January, we can see that 3 of those 4 quadrants wanted the market to go down. And that's because the trade were 40,000 contracts short. The managed money, okay, very marginally, but they were short. 4,500 contracts, it really is nothing. But the on-call the on-call sales, so the mills, had a fairly sizable position of nearly 68,000 contracts. The only people on the other side of the market were the on-call producers. So in terms of who's overweighted, there's way more people that the market can hurt if it rallies than if it sells, and particularly those of us in the trade and the on-call sales. Those mills that had telegraphed to the market, I've got all this cotton that I need to buy, and I haven't bought the futures yet. And so what does the market do? Well, it's obvious. Starts off flat, and then as soon as it digests this, it rallies. Goes from, 80 cents to 105. And there was a lot of pain. I think that a lot of us will remember, and I'm just looking at futures markets here, but a lot of us will remember that as the trade, those short hedges were obviously hedging physical basis length. And as the market rallied 30 plus cents, the basis got crushed. So we as the trade, a 40,000 contract short position doesn't sound like much, but it wasn't the margin call on that was hurting. It was the destruction of basis that really, where we really felt the pinch. So then let's fast forward a bit to the 4th week of Feb, which is the point where the market has now rallied very dramatically up to 105 cents a pound. So I hope you like my topical picture. It was a bit more topical when I put this presentation together, but so positions had changed a lot by then. The trade had actually added quite significantly throughout that pain, But the really big changes, well, the really significant change was managed money. And they had gone from being square to adding 95,000 contracts. And the on-call sales hadn't really changed, and the on-call purchases hadn't really changed. So if you're the market, you're that Terminator scanning the horizon, who are you going to fix on now? It's clearly going to be managed money. These are the guys who've escaped all the pain so far. Well, those and the on-call producers. But the on-call producers, they haven't really changed their position. The specs, they've changed it dramatically. In fact, during that time, that was one of the biggest and most concerted periods of fund buying that we'd ever seen in history in the cotton market. So obviously, we know what the market does, but if you didn't know what the market does, you could make a pretty good guess that it's going to fall, because these guys have got way overextended. And sure enough, I should also have, they took a pot shot at the on-call producers here as well. But sure enough, you can see that the market fell back down. Firstly, it fell. There was a large drop from 105, then it sort of hovered in this sort of 90 to 90 cent range for a bit. And then by the end of April, if we look at the chart, it said flat, then we had that big rally, fairly big decline, and continued attritional decline until we ended up back at 80 cents at the end of April. So you would think at that point that the market's dished out enough pain to everybody, but actually it hasn't. Let's just think one more step ahead. We've got to go from April to June. So we're going to chart or track the positions of those four quadrants. So the first one is I can't see on here, so you'll have to bear with me as I look at the screen here, is the trade. And you can see they started relatively short. They got a lot shorter, so they were taking their pain and adding to it. But they were pretty chastened. As the market fell from 100 back down to 80, they said, okay, we've got a chance to get our head out of the noose, and we're going to de-risk. And sure enough, they de-risked. Hedge funds, exactly the same in return. So they almost started back pretty much almost to the nearest 5,000 contracts where they began. On-call sales, bit of a flat line, but they were responsive. They started, I think we said the number 68,000, and they finished closer to 60,000. So they were relatively responsive to all these changes. They took a little bit of advantage. The one guys who really had their head in the sand were the on-call producers. It's difficult to see on other charts, so I'll show you here on a wider axis so you can see. So sure, as the market rallied, yeah, they fixed a bit. We like these higher prices. Then as the market fell, did they accelerate their fixations? Did they take advantage of 90-cent prices, 85-cent prices, 80-cent prices? No. They added more and more on-call commitments. So they were telegraphing to the market, they were telling us as the trade, they were telling this faceless Terminator, I've got all this cotton coming at me, but I'm going to, just ignore this opportunity you've given to me, and in fact, I'm just going to, I'm going to get more and more and more overextended. And if I go back to my description of how I feel the market, it holds grudges, it's merciless, it's relentless, it's unforgiving. So what do you think it's going to do to these guys? It's going to rip them a new one. And so it does. And so from April onwards, from April to June, we go from 80 cents to 67. And at that point, by the end of June, every single category in the market has had at least one period of just terrible P&Ls, of absolutely horrendous trading periods, whether it was the trade as their basis was getting crushed, whether it was hedge funds who bought the very top of the market, or whether it was producers who just kept on adding more and more commitments and turning a blind eye as these high-price opportunities to fix just vanished. Sorry. So I hope what I've shown is that if we just look at where people are positioned in the market, we can probably do the same thing now, dissect the market in the same way, and draw some conclusions about what actually might happen to price direction from here. And so what I've done now, and you'll see on these next charts, is just take a look at all of those same quadrants and see how they've traded throughout this year. So let's start with the PMU, the trade. So the way to interpret this chart, just to explain, is this is the seasonality chart of the PMU positions. So the darker gray area is the band which shows the previous maximum and the previous low, going back to, I think they started in 2006, 2007. And obviously the blue dotted line is the average during that period. And the red line is where those positions have been in 2024. So you can see that the trade are historically relatively, well, and in relative terms, long. I mean, they're actually net short, but they're always short. And so the fact that we're only, as the trade, roughly 40,000 contracts short, means that we are, versus average, versus history, a little bit more exposed on the long side in relative terms. However, in absolute terms, it's really not much of a position. So I think I've given this one a thumbs up. The trade get a pass, they're not overexposed. The mills. So same analysis, so you can read it in exactly the same way. The mills actually have less on-call sales open than typical. But again, it's a long way short of their historic minimum. But and in absolute terms, very sensible position. So I don't think we need to worry about them. The managed money is a bit more of a head scratcher. So you can see that a few weeks ago, they actually made a new historic low for how short they were. I think they reached about 52,000 contracts short. And so you can see there from weeks kind of 30 through 37 or so, they were carrying a very overextended short position. But they have corrected it. And you can see this actually was done prior to this last week's report, but the 3 weeks before that was actually the single biggest short covering rally that we'd ever seen in the cotton managed money positions. So they were chastened. They obviously looked at their positions, looked at the relative price level being in the mid to high 60s, and and they've moderated their risk to some degree. So I think, as I said, it's like a head scratcher. They're probably a little overextended, but they have at least paid some attention to it. Now, the ones who we really need to talk about are the on-call purchases. So, I mean, this chart speaks for itself. The seasonality is just off the charts. At 85, nearly 90,000 contracts of unpriced on-call purchases, we are almost 50% higher than the previous max at this time of year. Now, I think we do need to give a little bit of credit. In a lot of these previous years, we didn't have 3.5 million ton Brazil crops with, high 2 million tons, so 2.7, 2.8 million ton potential exports. And so it maybe isn't completely fair to compare this chart with some of history. But if you look at the on-call report, it's only about 35,000 contracts which are in the December 25 and later period. And those are going to be the ones that are, to some extent, low risk, a long way down the curve. The market can deal with that later. But even if you take those 35,000 contracts off and reduce that line, you're still right at the maximum. So I think the conclusion that I take from all of this analysis is that we've kind of got two competing overexposed entities, the funds and the producers. And I think the producers probably are weighing a bit heavier on that scale, which is what I've kind of tried to show here. And so if that is the case, then obviously it paints a slightly bearish picture. And so that's where I think I would like to leave this part of my presentation, just to say that, well, hopefully I've shown a slightly tangential way of looking at the market and interpreting the market. And I haven't had to get deep into USDA numbers, which would bore you to tears as well as me. So I'm going to leave that one here, and I'm sure Bill will be grateful that I will get back on track and talk a bit more about the more traditional way that, that some of these market presentations have been done. Having said that, I'm not going to, I'm repeating myself now, dive headfirst into S&D numbers. Instead, I think it's much more engaging to look at 4 or 5 topics which are probably a little bit out of sight, out of mind, but are actually, in my opinion, really important. And so what I hope I can leave you with when I finish today is just maybe a broader context to continue doing the analysis that you're already doing. I mean, I'm not here to teach you to suck eggs, but I hope that I can just add something that injects a little bit more, yeah, just a bit more pause for thought. And the first one of these concepts is, I've titled it Outliers, but maybe a better title from sort of behavioral economics background would be recency bias. And that's that there were 2 things last year that were really, really unusual, and we've completely normalized them, okay? The first one is Chinese imports. So this is a chart of Chinese imports going back to, what is it? Well, I can't read that, but a long way back, 40-odd years or so. And you can see that last year at 15 million bales was the 4th highest ever, and the only other times when they really exceeded that was when they were going through that enormous restocking program in the early 2010s. And so, but we just took it completely for granted that China was importing 300 tons a month, just continually. You know, we were getting bids on Brazilian, on US, 10,000 tons a day, and it just became normal. And the estimate for this year has actually gone down to sort of 9 or 10 million bales, and it feels a little bit bearish. But actually, 9 or 10 million bales is pretty good. And if we look at it in the context of 10 years, you can really see that last year was a massive outlier for Chinese imports. Now, obviously, it was related to a lot of politics, a lot of restocking of the reserve stocks. And it's always a conundrum for us to try and deduce what the policies are going to be and when that buying is going to come back. But we haven't seen any domestic auctions. And so I think we should continue to expect that the buying from China is going to continue to be commercial buying. And that means that 2 million tons, or 9, 10 million bales is actually a stretch. So I think we need to forget last year almost and think about think about these new numbers in the context of history other than last year. So when the State Reserve are not restocking. The other outlier, and this one I find really, really amazing in many ways, is that the US crop last year was the lowest in almost 40 years. You know, it was at 12.06 million bales. We hadn't seen anything like that since 1986-87. I was still at high school. That's how long ago it was. And again, we normalized it. We just dealt with it. Dry West Texas, yields terrible, abandonment terrible, and it was just, water off a duck's back. It was fine. So we had 2 things last year that were complete outliers. We had this massive ramp up in China imports, and we just had the decimated US crop. And the market, for the most part, other than a 3-month period, just took it in its stride. And so I think that, we need to, as I said, it's recency bias. We need to wash that away and try and compare what's happening this year with what happened over a longer period rather than just looking at last year. So the next concept I want to introduce you to, and this is something that I'll thank Joe for bringing my attention to. I think he presented this a few years ago, and it was after we'd had a period, I forget which one it was, when we'd lost consumption for 2 years in a row. And he highlighted that any time when we'd had 2 years of declining consumption, the third year had a really, really big bounce. And you can see it here. These are those periods. There's almost an 8% recovery in year 3 whenever we'd had 2 years of declines. And it doesn't matter what the decline was. There was, Asian contagion. There was the GFC. There was the reaction to the price spike in 2011. And then, we kept on seeing these big recoveries. But then what happened last year? Well, last year was the third year after a 2-year decline. We had a 0.5% recovery. So I think something structurally may have changed. And I wasn't here yesterday, so I'm afraid I missed a lot of the sustainability discussion, but the feedback I heard could be that something has materially changed. And this is a potential manifestation of that. And to add a little bit more fuel to this fire, let's look at what the USDA did during the year and how they changed their estimates. This is for 22 and 23, and 23 and 24. So what these two charts show is that the USDA, they released their full deck of stats in May of the preceding year. So for 22, 23, they would release the full set of stats in May 22. And so this shows you what in May 22, they estimated that the global consumption was going to be about 122 million bales. And you can see it ended up at about, I think it was 116 or so. And that's oh no, sorry, that's 113, isn't it, I think. And you can see the monthly cuts they made to get there. And so the USDA they've got their Coke formula when it comes to figuring out what they think global consumption is going to be. We don't know exactly what's in the formula. We know it's got to be global GDP, global population growth, some other parameters, and it's been pretty good. And so I'm actually quite impressed by their macro estimates. And they got it wrong in 22-23 by a long way. Then they got it wrong in 23-24, not by quite so much, but the trend is clear. So I think that these old models that maybe ourselves, but certainly the USDA are using, are a little bit broken and need to be adjusted. And unfortunately, they are broken in a overly bullish bias, in that they are projecting that we're going to be using more cotton than we actually end up doing. So yeah, that's my second topic that I wanted to cover, and just kind of put that worm in your ear. This one is much less, much more visible. I think we all are very, very acutely aware of how much government intervention there is in the cotton market. India, the second biggest producer, US, the fourth biggest producer, and both of them have got very, very extensive support programs. Administered in different ways, but they both end up manifesting with a support at a New York futures equivalent somewhere in the mid-60s. Everyone's going to have their slightly different calculation, but that's, in our opinion, roughly where they come into play. And I think India is quite an interesting one, because the way that the way that you feel it at this part of the season is that, as I'm sure most people know, the government have a buying price within India, not actually for cotton, but for seed cotton, so before it's ginned. And an Indian mill will look at what price the government's paying. They will impute that into a lint equivalent, and then they'll take that lint price and they'll see whether imports are cheaper. And that's not as easy as it sounds, because imports are at different tariff rates. So there's a full tariff of 11, there's some Australian goes in 0, and there's a spectrum of differences between there. So it's kind of different for every mill. But what we have generally found is that with the current MSP, it translates into decent Indian import support somewhere in the mid to high 60s. Now, this can change quite a bit, because once the calendar goes forward and the Indian government have built up stocks, and they may well have built up, quite conceivably, 1.5 to 2 million tons of stock if prices stay at sort of the 70-cent level and they continue with this high MSP, then the Indian government has a problem from April onwards. They've got this 1.5, 2 million tons of stock. What are they going to do with it? They generally recycle it pretty quickly. And the way they do that is they're pretty sophisticated. They look at where the where imports are, and they just know they have to offer it a couple of cents below where the imports are, and then the domestic mills will keep on clearing out their stocks. But what that does, the interesting thing from that is that it goes from being a program that's supportive of the cotton market during the months of, from now, say, through March, April, to potentially being a ceiling on the cotton market when the Indian government are destocking. The US loan, again, I don't have time to go into the intricacies of the US loan, but it is administered completely differently in that the US farmer can effectively pledge their cotton to the government at a price of 52 cents within the country. And they can redeem it at any time thereafter, basically at that price, or if the market falls, at the adjusted world price, which I should go on a little detour now to thank Mike for all of his time at Kotluck and dutifully calculating the AWP for me for the last 30 years. But can then pull cotton out of the loan at the AWP. But what that means is that for a US farmer, what I should have said, in our opinion, that 52 cents in the country equates to roughly 65 cents futures. And so what that means is that if you're a US farmer and you're long cotton and you haven't committed it to anybody, if the market is trading at 67 cents, you haven't really got any jeopardy. You know that if the market falls, yeah, you might lose 1 or 2 cents, but after that, the government's got you covered. So you get this dead zone where US selling just runs out. And I think we've kind of seen this in the market, in that the market gets down to 67, 68 cents. You get no hedge pressure from the US seller. You get plenty of buying from particularly India, but also the other countries in the Indian subcontinent. But then you get a little spike, goes back to 71, 72. Suddenly these US farmers, it's not that they've got 2 cents of jeopardy, they've now got 6, 7 cents of jeopardy, and they re-engage again. And so that I think explains quite a bit of this chart, which shows that there's this implied support at 65, 67 cents, and we just sort of bounce around marginally above that. So the takeaway for me on this is just that, which is a little bit of a boring takeaway, but while those programs are in existence, we are probably looking at a fairly dull range-bound market. And after all the excitement that I took you through in the first half of 2024, that's really what we've been in, yeah? I mean, since the July went off the board, it's really been a pretty stale market. And that leads on to my last slide, where I just kind of really want to push that point home. This is a logarithmic regression of the price that the market was trading after every USDA report, and it's looking at the USDA US stocks to use. And we use use in the US as domestic use plus exports. And you can see it's a pretty good fit. It's not great, but it's okay. And this was done with the September numbers because I had to prepare it last week. But the October numbers are actually 30% versus September was 29.23, so they really didn't change much. And you can see the projection is 72.53. Where's the market today? It's just below 71, or was when I came to stand up here. And so we're super close to this number. It's like we've got these government support programs narrowing us down, hedging us in. We've got our regressions telling us that we're pretty much fairly priced. So I can't really say anything exciting, either positive or negative, but it's just a very dull period to be talking. And I think this comes back to where I started from. I think I know why Joe was no longer available. He knew that there was no story, no narrative, nothing to say. So he passed the poison chalice on to me. So I've done my best, but I don't have anything exciting. We're not going to 105. I don't think we're going to 40. I think there's a lot of subtlety, a lot of nuance to play for. And I think the government programs are going to be a big part of how we navigate through the next 6, 12 months. But by and large, I think we're probably in for a period of dullness and stagnation. So on that slightly depressing note, I'm going to thank you all for your attention and time. And I believe there's a little bit of opportunity for Q&A. So thank you.